And welcome to Mongo Spaces this Wednesday evening. We're going to dissect the ratings changes from Moody's today. It's the guest today, David. So maybe, David, you can start by introducing yourself for those who don't know you and what you do and what your company does.
Sure. Thanks, Eric. My name is David Rogovich. I'm an analyst at Moody's Ratings in the sovereign risk team. I have a portfolio of credits that cover countries like Kenya, as well as several other across East and Southern Africa and Latin America and the Caribbean. And for those of you that don't know, what Moody's does is we assign credit ratings, and what these ratings are our opinion on the expected likelihood that a borrower, whether it's a business, a corporation, a bank, or in this case, a government, will repay its debt on time and in full to investors.
I think what most people don't know is that Moody's is listed and they are due to report earnings on 18th of this month. Is that true? And by the way, what's the meaning of the name Moody's? What's the origins of it as a company?
Moody's, the name comes from the founder, John Moody's, who founded the company 125 years ago. So that's where the name comes from. We have some posters around the office. We can see the first ratings were on railroads, and the first sovereign rating was back before 1949, somewhere around there. We had ratings. That's when we started the sovereign rating group and evolved since then. Now we have ratings on 143 sovereigns globally, covering the majority of countries that generate economic activity around the world.
And you serve both corporates and sovereigns, right?
That's right. Corporates, sovereigns, banks, as well as structured products. So across the board, everything.
And did you have part of Moody's that is more analytics oriented?
Yeah, so of course. So the way that we're set up is we have the analytical teams split up by rating groups. So sovereigns are one group. And then there are other sides of the business. There's Moody's Analytics, which is a completely separate company that offers a range of products and offerings. But for the analytical side of the business, the rating side of the business, we're split up by group. And you can discuss this more later. But when we assign a rating or monitor a rating, we do incorporate the views and have analysts from the banking team in our rating committees, in our rating discussions when that's relevant. We have analysts from corporates, or if we have ratings on SOEs or other systemically important companies in the country, then those analysts would likely be part of the committee discussion as well to make sure we have as holistic a view as possible.
And then in terms of Kenya and Africa, what's your role in ratings?
I've been the lead analyst for the government of Kenya now for about 7 years. And what that means is that I'm the main analytical contact point and the person responsible for monitoring developments along with a team. And so I would be the person communicating rating actions, communicating to the public in spaces like this, as well as other venues, our views on the sovereign. And then we have a team of 7 sovereign analysts that have responsibilities across Sub-Saharan Africa, North Africa, and the Middle East as well. We each have portfolios of credits from 7 or 8, depending on the credits and how high profile they are, how much work they require. So we've got a large team across the world. Each of us are experts in a sovereign in a country. We bring that expertise to our rating committees and their discussions when we monitor and assign and change ratings.
There's been a lot of discussion around ratings. That's why I'm digging a little deeper so that people can have context to how ratings are done. I think there is a lot that goes into making a credit rating. What goes into the process of making a credit rating?
That's a great question. We have continuous monitoring of all the ratings, all the issuers we have ratings on, but we are obligated now to have a rating committee on each company, on each government, each sovereign, at least every 6 months. And when you have a rating committee, what we mean by that is you'll have a group of 7 or 9 or more analysts that will come together, have a chairperson in that committee that is responsible for ensuring that the composition of the analysts involved in the committee is deep enough and has enough breadth to reach a conclusion, responsible for making sure that there are no conflicts between anybody involved in the rating decision that could prohibit them from taking a decision that's based purely on the fundamentals. And then there's a number of steps involved with checks in place, and ultimately have a discussion on the sovereign. It's a forward-looking view, so incorporate all information that's available, historical data, as well as forecasts. Our own forecasts look at different scenarios for the debt trajectory, for example, sources and uses of financing, and the committee process in the end. When we vote on the rating, it's one person, one vote. So it's a very democratic system where majority rules. So even at the start, even though I am the lead analyst for government of Kenya, it's not just my opinion or my view, but the view of the collective committee that makes these decisions. And we have a number of steps or processes in place also to ensure the accuracy of these ratings. We have a separate group within the firm that looks at rating actions and looks at default rates and assesses where ratings were prior to default, looks at the ordinal rankings of those sovereigns to check for the positioning before default X number of years prior to, also to ensure consistency in terms of how we are assessing different factors or variables across countries and across rating committees. So that's there to ensure consistency and accuracy. Ultimately, our purpose is to provide the market with a view and, again, our opinion on the likelihood of being repaid. And the market values this view for a few reasons, but one of which is that we have historically provided assessment that's provided a good ordinal ranking of sovereign credit risk.
And then once you've made like a credit rating, you do upgrades and downgrades. I tend to see that a lot of downgrades are met by a very strong opposition, and then upgrades are met with a lot of clapping. What's your assessment in terms of, there's been a lot of scrutiny, especially from the African side, in terms of how ratings are done. What can you say to some of those concerns that people are raising around that, especially when they're downgrades?
I think there's a lot of scrutiny, and there should be a lot of scrutiny because they do matter. They have an effect on borrowing costs. What I can say is that we continue to put in place measures and processes that ensure consistency. We have a methodology that we use that we make available publicly that explains the factors that go into our ratings. We apply this methodology for all sovereigns, and we periodically assess it and revise it and make changes to it. But the idea is that the methodology is robust enough and diverse enough to handle credits of different levels of development, different sizes, different economic structures. So the same methodology is applied in the same way to a country like the United States or Switzerland or Singapore, same way that would be applied to a country like Kenya or Nigeria or South Africa.
So this particular upgrade, what happened? Can you maybe give us a high-level view and then we'll dissect a couple of components there? First of all, what happened in terms of the upgrade, and then what informed your view of that?
We had a rating action. We upgraded the government of Kenya's rating from CAA1 to B3, and we changed the outlook from positive to stable. Now, outlooks typically signaled the direction of the balance of risks over the next 12 to 18 months. So when we assigned that positive outlook 12 months ago, we were looking for certain conditions and certain things to occur that could move the rating up or could be used to stabilize at CAA1. Ultimately, we saw enough progress over the last 12 months to move the rating up to B3. You can ask what those triggers were. And as we identified in the rating action press release, there were three key triggers. The first one being this improvement in external liquidity that we've seen. And however you want to look at it, when you look at the level of reserves, they've grown by around $3 billion over the course of 2025. Current account deficit, which in the past had been as big as 5% of GDP, and narrows down to below 2% of GDP and should remain below 3% even in 2026. And we've seen exchange rate because of these factors, because of the improvement in reserves, because of the current account deficit narrowing, the lack of external pressure, exchange rate that's been stable. And this was the first positive factor, a much larger liquidity buffer in terms of reserves to meet upcoming external debt. Because again, our ratings reflect the risk or the likelihood of repaying debt as it falls due. The second factor, and this ties into the first one, is the improved financing sources. Over the course of 2025, we saw the government access international markets and use this opportunity not just to issue new bonds to finance deficit, but to carry out what we would call liability management operations or exercises, effectively offering to buy back upcoming Eurobonds that were maturing in 2027, 2028, with this newly issued bond that matures at a later date. What that's done is it's reduced the amount of upcoming Eurobond maturities that the government has, effectively pushing out the next big maturity until 2030. So prior to this year, there was a bond, $1 billion coming due in 2028. That's been reduced significantly via the bond buyback or the liability management operation this year. When we look ahead the next few years, again, our rating is meant to be forward-looking, we see a lower risk of default, and that's exactly what a higher rating reflects. And the third factor is we have expectations for the fiscal balance and the fiscal deficit, and we want to be confident that we understand how the deficit will be financed and the risks around that. And here we thought there's been an improvement in domestic financing conditions. We've looked at bond auction data. We have a sense of the depth and the scale of the local market to absorb additional issuance by the government to finance deficit. And we looked at the cost of that funding, and all of which are pointing to signs that there's domestic financing conditions overall have improved. It was these three factors that reduce a near-term liquidity pressure. That doesn't mean that there are no challenges, and there are certainly challenges that remain around debt affordability and around fiscal consolidation. But overall, when we looked at the developments over the last 12 months in our view and what they mean going forward, we assessed that credit risks are lower today than they were before. Therefore, we moved the rating up to B3.
We'll dissect each of those three reasons that you've given. We'll start maybe with FX. Some market participants seem to argue that the recent stability around the shilling and FX reserves rising are mostly driven more by the central bank. Some active management going on there in terms of buying dollars and all, rather than market clearing fundamentals. Does that concern you when you're issuing a credit rating where the dollars came from, or is that not a key issue?
No, we certainly care about the sources of reserve accumulation. And as you described, the central bank being an active buyer in the market. The way that I would describe it is, I would say that for the past year or year and a half, there's been a situation where there's been excess dollar liquidity, and the central bank has purchased some of those dollars, a significant amount, and that's built up this reserve buffer that gives them more flexibility to handle a future shock. And you want to have a reserve buffer of a certain level, because if you're faced with a temporary shock, a spike in commodity prices for an importer, some other type of event, you have these reserves as a resource to utilize to smooth out temporary volatility, to ensure that you have adequate access to critical materials, etc. And what they've done, you could describe it as being fairly prudent, that they've taken the opportunity to accumulate reserves this period of time when they have those dollars available to them. Now, you could say that the exchange rate, they could let it appreciate further. But I think that's the key point, is that, look, going ahead, seeing how the central bank, how they respond to movements or pressure on the exchange rate. The fact that the exchange has been stable and they've been accumulating reserves, that's the key, that the reserves have been growing. It's not that the currency's been stable and reserves were declining. We've seen that in the past. And what's one of the issues we noted in 2022, 2023, that the exchange rate was steadily weakening a little bit every day, and reserves are going down a little bit. And there's clearly a shift today compared to then. And this is a more positive dynamic than back then. Now, you can ask if this is sustainable. And I'd say we would expect that as economic activity picks up, especially if there's a pickup in investment and construction activity, that there should be an improvement and an increase in imports. And so you may not see the same pace of reserve accumulation via the central bank buying dollars in the future. But I'd also say at the same time, there's a certain level of reserves that, are considered adequate. Some would say 3 months import coverage. Others say 4.5 or 5 months. We're at 5.3, 5.4 months of import coverage right now. There should be a big inflow from the Safaricom privatization. So I don't know that we need to see reserves accumulate. We need to see reserves stay where they are and understand and monitor the sources of financing for the fiscal deficit for the amortizations. Because as we note in the press release, the government has between 2.5 and 3 billion in terms of principal external debt payments due per year. Plus, on top of that, you have interest. So you're talking about we're close to 4 billion, 3.4 billion plus any amount of the fiscal deficit they finance. So quite sizable external gross financing needs. So they do need to maintain access to markets or access to concessional sources of financing. So reserves are one part of it. Having a larger reserve buffer helps. The exchange rate being stable, the fact that reserves are growing, I think, is what's important when we think about the level of the exchange rate and what that level of exchange rate does for competitiveness of the economy, for trade. And again, here we're seeing a narrowing of the current account deficit compared to the past. We wouldn't, based on any sort of fundamental measure of the current account and the exchange rate, you wouldn't seem to be misaligned in that way.
The second reasoning that you gave was around improved financing sources. Could you explain that a little bit more? And also, a little worry is that you find among Kenyans is also, if you upgrade the credit rating, the government has this urgency then. I think the next question is usually, should they go to market again and raise another Eurobond? And to helping to create this cycle where if they get a rating upgrades, they're actually eager to go to market and then raise a few debt and then accumulate that debt in that regard.
What I'd say about the improved access to markets is that there are a host of reasons or why this has occurred. But I think one is we have to acknowledge the fact that the government has access to markets. They have access to other sources of funding. Earlier in 2025, there was the bilateral loan from the UAE. There's been the restructuring of the SGR loan, which has reduced some pressure. And there's a number of other borrowing plans that are planned for this year, for next year. The samurai bonds, debt for food swap, a sustainability-linked bond, et cetera, that suggests that the government will have access to sufficiently varied sources of funding. But again, what was key with the issuance this year was not so much the fact that they had access to markets and they issued, but that they used that to manage upcoming maturities and taking the opportunity to buy back these bonds that are coming due so they don't have a big a large, lumpy maturity coming due 27 or 2028 when we don't know what's going to happen in the future, faced with a shock and you have a large payment coming due, it helps that now that next payment is not due until a few years later, to the 2030s. And there is a big maturity wall coming in the 2030s. When we assess the rating, we monitor the rating, and ratings aren't static. They do change as we had an upgrade just now. What we're looking for is looking at the pace of fiscal consolidation. This is a government, a country that, when you look at the amount of debt they have, is something that probably needs to maintain a regular access to markets to refinance maturing debt primarily, but also with a fiscal deficit of above 5% of GDP to finance part of that deficit. You asked a question about, does it facilitate additional borrowing? And one thing we always assess is, what is the borrowing being used for? And it's one thing if you borrow to repay a bond, you need to look at certain factors. But if you're borrowing to pay for recurrent spending, salaries of employees, it's one thing you're paying. If you're borrowing for infrastructure or for investment, then we look at the quality and the effectiveness of that investment. Is it going to pay off in terms of higher growth? What is the borrowing strategy? A lot of the projects have project loans attached to it, which are concessional. When you're borrowing in the market or from bilateral creditors, we've seen cases where countries will borrow to finance a project that doesn't ultimately pay off in higher revenues or higher foreign currency earnings in the future. And that is where you lead to the buildup of debt and challenges with servicing that debt. Here, again, we assess all projects. We look at them. We look at the history, the track record. We look at measures of institutional strength, governance strength. There's a lot of external data available to look at these things and make an assessment. And we also assess what the future fiscal trajectory looks like. What is the forecast for revenues, for expenditures, growth? We take all of that into consideration. We don't give advice on how to finance a project. That's not our job. Our job is to assess what are the risks associated with that borrowing and with the overall credit profile.
In terms of going to market, I think one of the other things that has reduced maybe the appetite to go to market is securitization. I think that's one of the key themes of the government, to securitize as many of their projects as possible. There is one, I think, that has the Railway Development Fund. They're also selling off a couple of assets to also raise money to be able to set up a sovereign wealth fund and all. Do those usually factor into your consideration around ratings, or do you consider that off balance sheet borrowing?
No, everything factors into the rating. And the first thing on securitizations is to say that it's not uncommon. It's not something you see every government do, but there are other examples of countries that are rated single B, B3, B2 that have used securitizations. I think in Kenya's case, the issue, or what we flag, is that this is a country that already has a very narrow revenue base. It's about 17% of GDP, total revenues. Tax revenues are like 14% of GDP, but we include non-tax like these levies. It's around 17% of GDP. They've historically struggled to really raise that. In fact, that's declined over time. Now you're taking a portion of those revenues, the road maintenance levy, and you're borrowing against it. So that effectively those revenues are not available to service your debt or to pay interest. And in our methodology, when we look at a sovereign, we look at something called their fiscal strength. And we don't look at the size of securitizations or off-balance sheet borrowing. When we look at government debt, we look at it as a share of revenue. And another indicator we look at is interest payments to revenue. And this has historically been actually a better predictor of defaults than debt to GDP, but interest revenue. Kenya's case, that's already 33%. If you securitize part of the revenue streams, the levies, you're reducing that revenue base further. And so unless that's offset by increases elsewhere in revenue or decline in interest payments, that ratio will worsen. Your debt to revenue ratio will worsen. If you look at Kenya's today, say 17% of GDP, but you start to strip out some of those levies because they're being securitized, that does pose a risk. I guess the other area people will bring up is the risks around who's buying the securitized bond, and is that creating some risk in the future, or are there legal challenges or concerns? I'd focus on the first part, the revenue base, the revenue available to service debt being constrained. The offset to that is that this is helping the government to achieve its development needs or infrastructure investment or to reduce arrears. And we would look at the overall strategy around the use of securitizations, the infrastructure funds, what they're being used for. Again, is it being used effectively? You can only privatize a company once until you've reduced your stake in the company. How is the money being used? Is it being used efficiently or effectively? And will it pay off ultimately in higher growth in the future?
So it's more of checking out where the money is going to after being securitized, and are those projects going to return enough money to be able to offset the costs of borrowing in that regard?
Yeah, you could put it that way. It's, again, how are you raising funding? What is it being used for? What are the alternative uses for that funding? Those sort of things.
So in terms of best practices that you've seen in these other countries in securitization, are there thoughts you have around what makes a good securitization?
No, again, we're looking at it from whether risks from how is it structured. I can think of one or two examples where understanding the structure and then ultimately the legal framework, I think, are important. But again, for a case like this, it's more those questions are there, obviously, but the main issue is, again, in the revenue stream and whether the government, effectively, when you have these levies, they're effectively meant to be ring fenced and used to finance spending. So in essence, there's no change in terms of the revenue and the expenditures. It's just front loading that or how you pull it together, assuming there's no legal issue, assuming there are no other risks around it. I think whenever you use a levy, it reduces that revenue stream that you have, and you need to be certain that levy will be a certain level in the future. In this case, I think that there's limits on how much they're securitizing, so it's not a large share of the overall amount of being collected. That should limit risks to some extent.
Around the upgrade, expectations around the fiscal deficit, you have a case of around 6%. And around debt being around 67% of GDP. And then if you look at it, you told us that you did look at local market data and they show like domestic financing conditions are pretty robust. I think that's been interesting to note that even as interest rates have been declining, there's been pretty robust demand for government debt generally when they issued the local markets, mostly been oversubscribed, especially those IFPs and all. From your observations then around that, what is your thoughts around how the local market is developing, maybe the over-reliance from government on this local market, especially in this financial year? I think they're well ahead of borrowing targets, and also how that maybe may impact us or would squeeze out the companies that want to invest, so to speak, and then they are not able to access loans and all because the government has crowded them out. What are your thoughts around that?
Those are good questions. I have a few thoughts. First, just when we look at Kenya, we compare it to sovereigns around the world, and we look at other sovereigns at the similar rating level. Some are completely reliant on external concessional financing, have very small domestic markets. So the fact that there's a domestic market does give Kenya some flexibility versus other countries at the same rating level, and give the capacity to run a larger deficit without needing to rely entirely on concessional funding. It doesn't fit Kenya's structure being graduating from purely concessional funding from the World Bank, for instance, right? There's a limit to how much they can borrow that way. Then on the fiscal deficit, just to clarify, so our deficit, we're expecting deficit to remain more or less close to where it is, between 5.8, 5.9% of GDP. So effectively very limited or no consolidation at the headline level. But as you said, that does stabilize debt. Debt's at 67% of GDP in a country that's growing around 10% in nominal terms. So what's 5% real growth and 5% inflation. You can stabilize debt if the exchange rate doesn't move with a 6.5% deficit. That's assuming the exchange rate doesn't move. But the key in what we've observed, and we looked historically at this, we look at government's projections in the budget each year, and historically they've overestimated revenues. This is even excluding the pandemic year and the 2024, where we can't really look at the budget for the forecast for the year ahead. They've overestimated revenues by about 1.2 percentage points of GDP, or about, I think, 7 or 8% in nominal terms. So there's clearly been this overestimation or expecting higher revenue collection or intake than been achieved. And we have that as a baseline, that their revenues stay flat. And we have expenditures remaining roughly flat. And this takes into account sort of the volatility or cyclicality of around the election year coming up, other spending priorities, also the interest bill. So that's how we get to that 6% deficit, or slightly below that. Then we look at the market condition. And what we observed is obviously from late 2024 through today, yields have come down, whether it's T-bills, bonds. Although we have noted that in the last few months, that the pace of decline in those yields has slowed. So we're not expecting significant further decline from here. Now where governments can borrow longer term at 12.5% to 13.5%, a short term much lower. That's enough to stabilize the interest to revenue, our preferred measure for debt affordability. It doesn't improve it because still, again, you're borrowing at 12 above in double digits or low double digits. It's expensive relative to external debt, though there's no FX risk. So it's expensive. So it does keep the interest bill higher. If the deficit were smaller, that might help, but it's not leading to improvement in debt affordability, which is also, I think, something that's different from our past forecast. We'd always assumed in the past we would see some improvement either from revenues growing or from interest coming down for this improvement, a decline in this interest to revenue ratio. We're not forecasting that. We're expecting it to stay where it is, roughly. And so that's baked into our higher credit rating at B3 today. You did make a good point, though, about the crowding out effect. And when you do rely on the domestic market for 800 billion shilling a year, 3-4 percentage points of GDP, that has an effect on borrowing costs. And so, it's not uncommon for sovereigns at different rating levels to see this, but And we do see the amount of domestic issuance likely making it more expensive for others to borrow, but that comes down to the choice of the financing mix for the deficit and the size of the deficit. There have been improvements in monetary policy transmission that we've noted in the past. So that's helped to bring down rates. But if there were less borrowing from the government, then banks may have more capacity to lend to businesses and households. But as it is, we're expecting the government to remain reliant primarily on the domestic market for financing for the deficit.
And when you look at the risk side of it, you highlighted a few in your report. Could you expound on some of the risks that you see baked in your upgrade?
When we upgrade, we assign a stable outlook or change outlook to stable. And what that means is that over the next 12 to 18 months, roughly, that risks are broadly balanced, the upside and downside. And the main risks being the pace of fiscal consolidation, access to funding, the cost of funding. Our baseline has a steady sort of fiscal deficit debt level. In terms of risks, we always try to identify what can move the rating up or down. Moving the rating down, we say a negative outlook, we'd say would be triggered by a significant weakening in the fiscal trajectory, particularly if it leads to an increase in borrowing costs, of worsening debt affordability. I mentioned before that Kenya's interest to revenue ratio is 33%, very, very high. That's a better indicator of default than debt to GDP. It's the sixth highest among all sovereigns that we rate globally. So it's a very high ratio. If this were to worsen further, that is a key that we're monitoring. The other area is on the external side. And if we see a decline, not just a decline in reserves, we see an increase in external pressures, widening in the current account, a decline in reserves, and less access to external financing. Those combined would weaken or increase external risks or external vulnerabilities that could put pressure on the rating. But again, there's not our baseline scenario, but we try to hide the risks, both the upside and downside. And then on the upside, a faster pace of fiscal consolidation and further improvements in the maturity profile, maturity structure of external debt in conjunction with the buildup in reserves would be positive, because again, we're trying to assess, or we express our opinion or view on the risk of being repaid on time or not being repaid on time and in full. One of our ratings reflect the absolute level of risk, but also an ordinal ranking. And so if we have a sovereign, we take Kenya, and it's rated lower than another sovereign that defaults, we're not doing a service by providing that ordinal risk ranking in that sense. When we see risks being lower or receding, at least in the next few years, that's what drove this decision for the upgrade to B3, saying that compared to other CAA1 sovereigns, B3 sovereigns, Kenya's credit profile is more similar to that B3 sovereign and slightly lower credit risk than it was before.
You said the revenues, you're projecting them to be almost flat. Is that informed in any way by the 2024? There was the Gen Z protests that were there in 2024, and then next year is an election year. So usually around this period of time, there is a bit of pressure from government not to raise taxes, but more to keep them stable. I know that part of it was informed by the fact that we obviously overshoot in terms of projections around revenues. But is that in any way informed by the civil unrest and then also the elections coming up next year?
I think the public statements from government have really been clear that there is not a lot of scope or capacity or interest at this moment to raise taxes. I think still they have the medium-term revenue strategy, the different areas they look at that there's a lot of potential ways to increase tax collection even without new taxes. But again, we're not baking in any sort of efficiency gains or improvements in tax collection. What we are factoring is a steady state potential for tax cuts, and we haven't assessed that and said that there will be. We follow public statements from government, and then we look at the forecasts and we look at the realism of those forecasts and try to assess, okay, what's driving that? How do our forecasts differ based on growth and elasticity and things like that? We look at how responsive are tax collection to growth in different sectors in the economy. And so we look at with everything, but we have seen public statements saying very clearly that there's not a lot of room to raise taxes right now. That's part of why I think you're seeing the strategy and the focus on privatizations and securitizations, finding other ways to live within the sort of constraints, the confines of the political and social dynamics in the country.
And compared to peers who are also similarly rated, how does Kenya compare in terms of debt distress? And I think that's also been a key topic in the past year or so on how close to debt distress Kenya is at. Could you maybe speak from your experience and looking around at Kenya's peers? How does that look like?
And the debt to GDP ratio doesn't stand out as being significantly higher than peers. There are different peers. Nigeria, B3, has a much smaller revenue base. Debt to GDP is lower, but debt to revenue is much higher. The level of revenues in Kenya is not in sync with or out of line with peers, where the key issue is that in Kenya's case is this interest to revenue. It's twice as high as the median sovereign for a single B, so B1, B2, B3 rated sovereign. Above 30%, there's very few sovereigns above there. And the risks around that are very clear, that when you're taking a third of your revenue to service interest alone, and you're running large fiscal deficits each year, that if you're faced with a situation where interest costs rise significantly on new debt, and on debt as it's being refinanced or rolled over, that creates a risk that that ratio grows and grows and leaves for less room for other spending. Here, again, just to be clear, that's not our baseline or base case scenario. It says, just noting that risk over there. Here, we think that there's enough access to financing that doesn't occur and everything else we talked about before. But that is the key area. There, again, Kenya has the sixth highest interest to revenue ratio globally, and most of the other sovereigns are rated B3 or lower. So it is a key constraint when we think about what can move the rating higher or lower. It's not, we look at everything together, but in this case, we would look at this as one factor, and understanding the dynamics behind it would be important, but that's where Kenya stands out in its peers. Other areas where Kenya stands out among its peers, on the positive side, the size of the economy, most other sovereigns that are rated single B are typically tend to be smaller, above 100 billion. Kenya is relatively large. On a global scale, obviously not as large, but among rated peers, you have a lot of smaller island economies in the Caribbean, in Asia Pacific. You have other economies. There are others that are larger. In general, the size of the economy is a little bit larger, more diversified. Again, when we look at Kenya versus other sovereigns, it's not relying on a single commodity. When we look at one indicator we use when we assess economic strength in our parlance is we look at volatility of growth over the last 10 years. And Kenya has one of the lowest growth volatilities among all sovereigns. So the way that we measure, it's one of those. So that does speak to the diversification of the economy, the steady sort of growth rates in the economy. Where Kenya is weaker, Kenya does, like I said, have a much weaker interest to revenue ratio. This track record of fiscal policy effectiveness, which we've seen a steady rise in debt over the last decade or longer, is a challenge. And then you look at the debt structure, there is a lot of debt that's coming due to commercial creditors, syndicated loans, Euro bonds. That means that Kenya is more susceptible to shifts in market conditions than maybe other sovereigns are that have the same rating level, but a different composition of debt.
And then what other factors would you consider in terms of an upgrade going forward? And then also another key theme that the government has had other than securitization is public-private partnerships, which tend to create liabilities there. And those factor in terms of your assessment and credit rating also.
Yeah, again, the PPPs, we look at the contingent risk, and PPPs are probably more prevalent in other countries and other regions where there's a framework and a longer history, a track record, an understanding of how they work. There is that risk that there's some contingent liability from these PPPs. But when you look at the stock of PPPs, it's not that large where it creates a significant risk. We have a way to factor this into our methodology and in our framework, where we have a certain threshold above which non-financial public sector debt, and you can include PPPs or contingent liabilities there. When I guess it grows to a certain level, and that level is much higher than where it is in Kenya today, it does trigger an adjustment, a notching in our framework. We're not there. So again, we do consider this all together when we determine the rating level. PPPs are something we factor in as well. Privatizations, it's something that a few years ago, when the government first discussed privatization, there was a privatization bill, I think back in 2023 or 2022, and they listed 47 SOEs they wanted to privatize. And the idea was in improving the efficiency of these companies, these SOEs. And at the time, we had a view that maybe there are some that are profitable they could privatize, but other ones would be difficult. So overall, the impact will be neutral here. Again, it goes down to what are the funds being used for, whether it's Safaricom or KPC or whichever company. And again, you only have privatizations, you can only use those once, so they're one-off revenues. So if we see an increase in reserves because of the privatization, we don't assume that's going to continue going forward. But at the end, if there's an infrastructure fund that has that funding there available, that does provide some flexibility relative to a scenario where you don't have that level, that pool of assets.
And one thing about you also do come to Kenya at least once or twice a year to actually see things on the ground, as the Kenyans say. What observations have you made in terms of the macro and how the numbers look like, and also the micro in terms of how the common Wananchi is actually experiencing some of these structures that you cited? Because when you talk to Kenyans mostly, they get that the government is really focused on making sure the macro numbers look good, but then there are a lot of cries around the micro, and people are being affected in a serious way, especially the small businesses and all. What's your assessment on that, and what can you speak to from your experience?
It's an important point that you make. We do come to visit every country that we rate, or majority of countries that we rate, we visit. at least once per year. We try to meet with as many stakeholders as possible, depending on the country where you go. But it's important for us to be there to have those meetings to assess and to understand the developments in country when possible. Kenya is obviously a country that's important and to us, we travel there often. I think what we hear there is what we publish in our reports. When we think about the social, the political environment, the appetite for reforms. And in the past few years, when there was increases in taxes, other deductions, you would hear those same, what we've discussed before, the same sort of pressure on small businesses, trying to shift from the informal to the formal sector of the economy, the challenges associated with that when you have greater taxes there, changes in business regulations and taxes and how that affects business competitiveness when you have these, especially economic zones and what that does. And if you have a business that you're running, it's based on a certain operating assumption in terms of taxes, and then you're faced with new taxes and duties or excise duties, it has an effect. At the same time, there is still a vibrant private sector. I think the challenge of the last few years that we've seen and noted is the decline in real wages. And it's not just in Kenya, but a lot of countries, the inflation shock from the Russia-Ukraine war and the spike in commodities. So the decline in real wages and the lack of formal employment opportunities and the formal employment growth has been something that you can see in the numbers. Part of that's probably due to a tighter fiscal stance, tighter monetary policy stance in the past few years. Now that those are monetary policies easing, we'll see if credit starts to flow through to the economy, and that can pick up, if growth can pick up from there, if employment can pick up from there. But these are challenges, again, that we see around the world, really, from developed countries to developing or emerging markets. It's something that's an issue not just facing Kenyans, but everybody, really.
From your experience with Kenyan peers in the credit rating group, what are some of the things that you've picked up which Kenya can do to also make sure that they do better themselves as a country?
I think the areas when we look at on a peer comparison basis, I mentioned some of them before. If you look at inflation targeting or the monetary policy regime, the exchange rate stability, especially on the inflation targeting, there's a difference. You look at the peak in inflation in Kenya in the last few years was just above 10%, and it came back down, and then inflation has been within target. So that, in part, at least the development of the domestic market has helped, gives Kenya an advantage, I think, at the expense of higher borrowing costs compared to peers. So that's one area. And then again, I said before, I think the debt structure and the reliance or the greater reliance on commercial financing in the past, it's been something that it can exacerbate liquidity challenges. We saw in 2023, syndicated loans were expensive, very short term. Now market conditions have changed a little bit, and better access to funding longer term is helping. That does, I think, leave Kenya more vulnerable to these shifts in financing conditions.
And then a small part of the rating is issuing a rating on ESG. Could you speak a bit about Kenya's ESG credit impact score?
So what we started doing, this is several years ago, we started to publish what we call issuer profile scores for environmental, for social, for governance, risk factors, and then a credit impact score. And what the issuer profile scores do is they're meant to provide greater transparency in how we assess various types of ESG related risks in the credit profile. It's not something that adds on or is in addition to the rating. It's probably says how are these factors baked in or factored into the rating. So how do we incorporate physical climate risk, right? And we assign a score on a 1 to 5 scale. And then we try to explain physical climate risk, what that means, and weather-related shocks, how does it affect the credit profile, the need for volatility and growth, agriculture output, and the need for subsidies. We can directly link that exposure to the credit fundamentals. And then we look at the credit impact score, and that, in the case is a 4. So 4 out of 5, 5 being the highest. And what that means is the credit impact score goes from a 1, which means it's a positive influence, and there's very few sovereigns that have a score of 1, to 5, which means that in the absence of these ESG related risks, the rating would be several notches higher. At 4, it's saying that the ratings, because of these ESG related factors, and that includes governance, which kind of maps to our methodology, but includes things like the history of pending bills and arrears, monetary policy effectiveness, the fiscal policy effectiveness, the overall institutional framework, the social risks, access to housing, access to basic services, education, demographics, environmental risk, physical climate risk, natural capital risk. At 4, we're saying that the rating is lower than it would be in the absence of these risks. And two clearest ways to think about it is in the absence of the fiscal costs and the volatility created from heavy rains and droughts and the effect that has on rain-fed agriculture, or the impact of comparatively weak fiscal policy effectiveness. In the absence of that, would the rating be higher? The credit impact score of 4, we're saying yes, the rating would be higher by a notch or so. So that's how we incorporate it. I think it's something that we try to use to improve transparency around ESG-related risks and how they ultimately affect the credit rating. But it's not a rating. It's not something that on its own worsens rates. It just explains how we incorporate these factors into the rating.
On the Africa-wide context, I think last month, Fitch Ratings, with the new ratings for the Afrexim Bank, usually when it comes to ratings, what informs like a ratings withdrawal, especially from an institution, and then how does that play out in terms of relationships? And then if you were to advise African government in terms of how they can achieve stronger ratings within existing methodologies instead of perhaps having an own credit ratings agency, what would you tell them if they're listening?
A tough question to answer and say I wouldn't comment on other rating agencies and their policies. We have policies on when we withdraw a rating, and the clearest one is in terms of data availability. If there's a sovereign that we don't have enough data or the quality is not good enough, that we're not comfortable assigning a rating. And this goes to the questions we get related to data issues and how can you assess the rating if you don't have all the information. At a bare minimum, if we don't have the data that we need for a rating, we wouldn't assign a rating. So we wouldn't just say, oh, we're not sure about the data, so we'll notch it down. No, we wouldn't have a rating if we didn't have data that was sufficient and that we thought was important enough to have the rating. So that's the clearest time that we would withdraw a rating. I can't comment on another rating agency. And then the same on policy advice and rating. We're very clear that job or mandate is on assessing credit risk. We don't give policy advice. There are really great institutions, UN, elsewhere, that do that. Other institutions that give advice in terms of the measures to take. It's not our place to give that advice. We're focused purely on one aspect, which is the credit risk.
So perhaps now in winding up, what are the key things that you want investors and those listeners to take away, especially from this B3 upgrade? And what are some of the common, perhaps misinterpretations that you see with upgrades and downgrades that you would want to caution our listeners and investors who are listening in? So perhaps you can tell us a bit about that, or some key message that you want the investor to remember, and then also some common interpretations that you would want us to address as we close.
In terms of the rating upgrade and the action we took, it does speak to the fact that ratings are not static, that they do change as the fundamentals change, whether in a positive way or a negative way. We'll take those rating actions. We obviously came from a CAA1 rating level, which is a relatively low rating level, but we have a 21-point scale that we fit to 143 sovereigns. We need to rating upgrades and downgrades and moves are typically one notch at a time, occasionally two notches at a time, but they're very small gradations on that scale. And so we're trying to reflect the overall credit risk at a particular rating level compared to peers. So the key message there is that an upgrade, downgrade, it indicates one thing, which is the level of credit risk relative to the past, relative to peers. It's not a view on the economic outlook for a country. It's not a view on politics in a country. It's a view on the credit risk. We like to say we're agnostic on politics and political systems. We assess purely the credit fundamentals. So that is the message of these. This is a reflection of a case where we took actions in the past. In the past, there were downgrades. Things have improved, and we've taken action to have an upgrade. That message, I think, I'd like to leave everybody with.
Thank you, David. Thank you for your time.
Thank you, Eric. Thank you, everybody, for joining.